Hey traders, it's John Fortune here with an explainer video for the weekly Forex forecast and the weekend analysis videos. I get asked quite a lot questions such as, where the levels come from, questions about the process. And so I wanted to do an explainer video just to help people to understand more what we're doing in the weekly Forex forecast video, before the weekly Forex forecast video, and the process overall in general that we're not using just in the weekly Forex forecast video and the weekend analysis videos, but also throughout the week with GMT members. So I wanted to do it in the format of the weekly Forex forecast, and we always start with the dollar, of course. And the reason we start with the dollar is because of its importance as the global reserve currency. Flows into and out of the dollar can have risk on and risk off effects across other currencies and other markets as well. I mean, it is a very, very, very important asset, not just in Forex, but in the global marketplace. So we start with the dollar, and I also share with you any major upcoming news events. And I will often say, and it's really good to look at the dollar today because it helps with the point that I'm making here, which is that if we have an upcoming news event, usually I will put that into the weekly Forex forecast, and I'll often say to you that I'm looking to trade after the event itself. Why? Because news events, news catalysts, it could be an interest rate decision, it could be non-farm payrolls, which is what we got today, or it could be an earnings report. These kind of major catalysts can not just move markets, but they can change the direction of markets. And so if you ever get involved before a major catalyst, you can be on the wrong side of it. Now, it's not the end of the world if you are on the wrong side of it. Let's say the dollar is strong, you're looking to buy dollars, and it breaks down to the second lower bound. You can risk manage it, and in real trading, there is no kind of closing the account and starting a new demo account, right? You have to trade your way out of these things. And this is something that I'm going to show you in today's video, a real example of a trade that I took this week, posted to members. It went against me, it didn't work, and I risk managed out of it from the second lower bound, which is what I talk about in the weekly Forex forecast and the weekly analysis videos often. And on top of that, I'm also going to look at some examples throughout this week of these kind of setups. And also I will post a couple of trades that I did personally take and post to members this week. And I'm going to take one which didn't work, and we'll be looking at one which did work, just for a nice balance. So that begs the question, what are the levels? And this is a question I get asked all the time. The answer is that no, to those of you who ask me quite often, I don't draw these on. These are not drawn on levels. These are automatically generated levels in the HedgeDash quantitative trading platform. Now, this is not a HedgeDash video, so I'm not going to go in depth about the HedgeDash features, but this is what we're using in the weekly Forex forecast, weekly analysis videos. This is what I take my own trades from. And it is something that all GMT members get access to with their GMT membership. And the HedgeDash platform is a quantitative platform. So what it's showing us here, specifically with the levels, this specific signal, you could say, or this specific piece of data or indicator, whatever you want to call it, this is showing us the forwards-looking probable ranges for each asset that week. And those probabilities are priced with roughly, you could say, nominally it's at 68% chance to the upside, 68% chance to the downside. What that means is if you break the upper bound, theoretically, 68% chance of rolling over. If you break the lower bound, theoretically, 68% chance of bouncing. Now, why do I say theoretically? Because in reality, if you've got a very, very strong market, you're much more likely to break through the upper bound than you are to reverse. And if you have a very, very weak market, you're much more likely to break through the lower bound, the first lower bound, than reverse. So this is one thing we always want to do every single week. We want to start to look at not just the probable turning points for these assets, but also we want to look at which direction we should be trading each asset. And we want to come up with a directional bias. And this is what we do in the weekly Forex forecast videos, the weekend analysis videos. You will always see I have a single directional bias on each asset. In other words, I can either be a buyer of this asset or do nothing. Selling is not an option. Or I can be a seller of an asset or do nothing for that week. Buying that week is not an option. And what we're doing, if we take this and turn it on its head, essentially if we have a very, very weak market, instead of going into an asset and saying, well, if it breaks the upper bound, I'll short it, and if it breaks the lower bound, I'll buy it. Well, 68% chance, yes, if you've got a very ranging market perhaps, but if you've got a very strong market, those percentages will change. And not only we have a higher probability, let's say in a weak market in this case, of breaking the first lower bound, but you will also have a higher probability of reversing from the upper bound should you push into it. And it's worth pointing out, this is not just for Forex, this is also for stocks and commodities and individual stocks and stock sectors. And in fact, you can see the weekly upper bound top ticked the high in the S&P 500. And this was actually something I shorted with members, timestamped it in the GMT members area this week. So really that's what we're looking at. We're looking first and foremost to identify markets with a high directional probability to the downside. And we're looking at shorting those on the bounce. So another way you can think about this is if that asset becomes overbought on the week, I'm looking at shorting it. And if that weaker market becomes extremely overbought on the week, in which case it breaks the first and second upper bound, I can also look at shorting it. And as we're going to go through an example in today's video, if we break this and I'm already involved, very often I use that second one to cost average it. And vice versa. So if we have a very, very strong market and we pull back, I'm looking at buying those markets intra-week when they become oversold. And if we break the upper bound, you know, in a strong market, you can look to book your profits on that as well. So those are the levels. That's how we're using them. The question is, how do we find the directional probability to know in which direction we want to be long or short so we can overlay the levels and then trade in that direction? And that's what we're going to do now. We're going to jump over to the portfolio selection part of the weekly Forex forecast and weekly analysis videos. Okay, so now we're on to the market selection or the portfolio selection part of the video. And the reason for this is because of what we just discussed in the last section, which is that in order to use the probable ranges that we use, because they're leading indicators in the weekly Forex forecast videos, in the analysis videos, in the hedge dash system, whether you're using those or maybe you're using technical analysis, these are market timing tools. They are not portfolio selection tools. And you have to have other parameters to determine your portfolio selection. In other words, what markets do I want to trade and in which direction? Then you can apply your forward-looking, technical analysis is forwards-looking as well. Price action is forwards-looking, or it's leading, I should say, rather than forwards-looking. It's a leading indicator. You've heard that saying, price is leading. It's true, technical analysis, price action is leading. But the probable ranges are actually forwards-looking, so there's a better distinction between the two. But either way, you want to take any kind of market timing tool and it should be overlaid onto an asset. You already have a good idea whether it's going to go higher in the week or lower. And not necessarily even in the week, but over the next few weeks. Maybe it pulls back for a week and you use that to buy the dip, right? But essentially you're looking for those outperforming assets to the upside, underperforming assets in order to be short. So this is where the market selection process comes in, and I do think this is probably one of the biggest mistakes many traders make, is that they try to use technical analysis, which is a market timing tool, for portfolio selection. In other words, they might say that they might flick through charts and look for bull flags. Well, just because you've got a bull flag, you can get bull flags in markets which are very weak and underperforming. It can look like this, it looks like a bull flag, and then the whole thing fails because it's fundamentally a weak market. You should really be looking at further declines. And any upside, you might be trading into a correction, and corrective waves, they're choppy, and the impulse waves are where you make all your money. So using technical analysis to try and select an asset to trade is a mistake. It's a big mistake. Many traders make it. In fact, many traders don't have a portfolio selection process. So they use technical analysis to choose assets. Most of the time, that is going to be very counterproductive and not helpful. So obviously, this is all made easy for us in the weekly Forex forecast because all of those numbers are crunched, all the calculations are done, and it produces a ranking in the hedge dash algorithms. And this is to show the general performance. Again, not necessarily this week, but over the next kind of maybe quarter, let's say. So if we know, on a quarterly basis that we should be looking at further advances in the Swiss franc, further advances in the dollar, and the dollar actually sold off to its second lower bound, and that's why I say it's a good example. Why? Because it's an example of a strong market, but which has a news catalyst, and that catalyst, the weak non-farm payrolls, pushed the dollar down into its second lower bound. So as long as you understand there's a non-farm payrolls report coming up, you get out of your trades or your dollar trades beforehand, then yes, it pushes against, it reverses the market, pushes into its second lower bound. You don't have to be in it because you knew that event was coming up. So you knew the risk around going to second upper and lower bounds was there, right? So this is very often why I say to you, I'd rather be in and out of trades before these events, or wait until the event comes out. It's Friday now, so it'll be trading next week, and then get involved in them. If you have an interest rate decision, very often Australia is on Tuesday, so you've got plenty of time throughout the week afterwards. So this is why we're looking at the portfolio selection process, and very often, the Swiss franc, essentially again on a quarterly basis, we should be looking at outperformance, the Japanese yen, and also the Australian dollar to the downside, the Canadian dollar to the downside, the New Zealand dollar to the downside has actually troughed this week. And how did Aussie franc fare over the last week or so? It got crushed. How did the CAD versus the Swiss franc fare over the last week or so? Got crushed. And these were all shorts we've been looking at before these moves happened in the weekly Forex forecast videos and with members as well. How did New Zealand franc, New Zealand yen, all of those commodity currencies have been getting hammered, especially against the safe havens, the franc and the yen. And actually, at the time of putting this video out, the past couple of videos have been about that, right? We've been looking for those risk-off, shorting commodity currencies, buying the safe haven assets plays. So this is why we do the portfolio selection process. There's not too much we need to go into this, purely because all of the data is all crunched, and basically it's very easy for us to assess. We want to be long these markets, say, versus these markets to the short side. And that's what gives us our directional probability. So for example, I can only be short Aussie franc or do nothing. Buying Aussie franc is not an option. And if you go and have a look at Aussie franc this week, it absolutely tanked. And that's why buying Aussie franc this week was not an option for me, right? CAD franc, cannot buy CAD franc this week. New Zealand franc, cannot buy New Zealand franc this week. Aussie yen, cannot buy it this week. Absolutely, in the process of crashing. We've got the yen carry trade unwinding as I speak. So this is probably the easier part. This is all done quantitatively, but it's a very, very important part. We're finding the markets which are most likely to outperform, most likely to underperform, and then we're looking at buying the dip or potentially the breakout in outperformers and selling the rip or trading the bear flags in underperformers. Okay, so now we're moving on to the watch list, and this is where, after we've done the portfolio selection and everything else, this is where we start to look at the actual assets that have a high directional probability to the upside, to the downside over the next quarter or so. They have a very, very kind of fundamental outperformance or fundamental underperformance. And this is where we put all of those assets into a watch list, and we begin to look at where we want to be buying or taking trades in those assets. And so there's three different setups you can really look for in any given asset each week. And I'm going to go through all three of them now with some examples. Starting with US dollar NOK. So what you'll usually see is, of course, we'll present this on the 4-hour chart, but this is an example of a market we may be looking at to the upside. And you can see quite clearly here, this would be one that we'd either be looking for long positions or doing nothing. Selling this asset would not be an option because of the overall outperformance of this asset, the strength of this asset. And this is really telling us we only want to be focused on buying opportunities. So what that would look like is simply this. We would remove the second upper bound because I'm not shorting from the upper bound here anyway. So there's no need to have a second upper bound because I'm not going to be cost averaging any shorts because I'm not looking at shorting. So very often it will be presented on the 4-hour time frame. And the reason it's presented like this is because this is the intra-week. The 4-hour time frame is the intra-week time frame. The 1-hour time frame is the intraday time frame. Of course, 4-hour is an intraday time frame, but the 4-hour chart aligns with weekly moves, and 1 hour tends to align with daily moves, etc. And stocks is a little bit different, more kind of 15 to 30 minutes, sort of on the intraday, and 1 hour tends to be, kind of more for the weekly because there's less, trading hours in the day. But to cut a long story short, that's why we're looking at it on the 4-hour chart. So it's not just that we're looking at only the 4-hour chart and nothing else. No, we're zooming all the way out from a quarterly basis and then coming all the way down onto the 4-hour chart. By the time we present the chart, by the time I show you the chart in the video, we've already had all of the quantitative data to show us, look, this is an asset we want to be long. And you can see here a very, very good example of why we would want to be long this. You see the market pulls back, tests, comes back for this stair step, tests the lower bound almost to the point, and we get a solid bounce. And this is exactly the kind of setup that I would be looking for. Exactly the kind of opportunity on the pullback and this bounce I would be looking at. And you've probably got, 1 to 2 days worth of volatility in there. So out of an entire week, and you can see, we start the week somewhere over in this area. Out of an entire week, we get this one move down, we bounce, and this is the move up. And notice how this happens almost straight away. So you really want to be looking for the markets, and this is something, we really are looking for the moves that go straight away. I tend to use time stop losses, which means that if a market doesn't work within a certain period of time, usually a day or so, I will just cut it. I will just get out of it. I won't stay in it because I expect the best trades, the best setups to work straight away. So this is a really good example of a market which pulls back. It's a strong market looking to only buy the dip, and we get a really nice solid bounce from the lower bound. Exactly the kind of setup we're looking for. Now, it doesn't always work like that, obviously, and we're going to look at some opportunities that don't work this week, and also some that I actually got involved with, which didn't work and which also did work. I'm going to show you the real ones from this week, the real setups with the timestamps that I took this week. So next market we could look at here is New Zealand dollar. Now this is a market, and this is how we present it in the weekly Forex forecast, but you can see there's other data that we're taking into account before we get to this point. This is an example of a market that pulls back right into its upper bound. And I did personally actually take a short here. It just kind of didn't really go anywhere, and then we kind of pushed higher on non-farm pairings. We're kind of stuck at the upper bound. But notice how the upper bound really did hold that. So even if you got short and that goes nowhere, you got the option, of pulling that trade, of getting out of it. And it hasn't really gone that far against you because, we've paused. We haven't really blasted through here. And you've got a weak market, it's pulling back. And I wouldn't be surprised to see this start to roll over potentially next week. Probably have a little bit more downside in the dollar, but I wouldn't be surprised to see this rolling over next week. And another thing to note is that when we look at the three opportunities, this is the first place I'm looking to short usually, very much or buy if it's from the lower bound, like with the US dollar knock bounce, really nice bounce to the upside. A short here, looking for that kind of 1 or 2 day reversal. But when you get that 1 or 2 day reversal, we've just seen it in US dollar knock, it comes down, bounces very, very nicely, almost to the pit from the lower bound like this. Very often, the following week, you get the intra-week breakouts. So for example, rarely do you actually come down, test the lower weekly bound and test the weekly upper bound in the same week. Very rarely does that happen, hardly ever. But what does happen is it tends to, for kind of swing trades, if you're looking to hold them for, multiple weeks, again, I'm looking roughly, 1 to 3 days. Most of the trades I like to take a day trades. If I can be in and out and capture pretty much a full day's worth of movement, I will get out, I'll book the profit and move on. But if you are looking to swing trade these things, like this kind of big bear flag here, very often, if we get a bounce this week, like in US dollar knock, the next week, when it opens and your levels are like this, that tends to be where you get those intra-week breakouts. So it's worth making a note, of the ones which bounce from their upper bounds, lower bounds, because very often those kind of swing trades are very often followed by intra-week breakouts the following week. Then they go to their upper bound. And if you get a market which tests its upper bound and it sits here, and then you get new levels the next week, is that going to be an intra-week breakout? It could be, but those are the weeks after testing its upper bound, it tends to test its lower bound, right? And then it bounces like this. And then you get new levels, and then that blasts above it from the intra-week kind of breakout. Does that make sense? So that tends to be how these markets move. Now, sometimes they will blast through, and this is often the first place I'm looking at shorting. And we'll see in a minute that, sometimes these blast through. This is the second place I'm looking at shorting. And if this comes down, this week, and we sit here and we get new levels coming into next week, this is where you can very easily see that intra-week breakout bear flag, and then it goes into its lower bound. Why? Because it tested the upper bound already this week. Makes sense? So it bounces, pulls back, consolidates, and then you get the intra-week breakout. Doesn't necessarily test its upper bound next week. I mean, this could test its upper bound next week, but that's very often how the markets move. And then, test its lower bound, and then you get the kind of pullback into the upper bound, etc. So next is EuroCAD. This is a market I can be a buyer of or do nothing this week. And this was a market that I actually traded this week. I did buy EuroCAD timestamps sent out to members. And whenever I take a trade, members get a picture of the market at that time. And what that does is it allows us to journal, to look back, and not just look at the trades themselves, but actually look at the price action and where the market was at the time of taking that trade. I always find if you're journaling your trades, don't just journal your returns. Take pictures of your charts, take pictures of your trades, where you entered them, how you entered them, because it gives another layer of learning when you can look back on your journal and not just see the returns for your trades, but see the trades themselves. So we always take a picture at the time of taking a trade. It always gets sent out and logged by email to members. And then on the Monday, we go back over all the prior setups from the prior week and just add them to the running total and account for everything. You know, we have a weekly wrap report, which basically accounts for everything, winners or losers, adds it to the running total, and we just have that kind of finger on the pulse each week for accountability, transparency. So this was one I traded this week. I have to tell you, this was a fantastic entry. I got this right down here when this day was actually red. But I also have to tell you, I left quite a bit of this on the table. This was a solid trade. This was a really good trade actually in terms of a day trade. Got much more than the 1 day's worth of volatility out of it. But this is a staggering move. This is actually one of the rare times you see how it tests the lower bound and it tests the upper bound all in 1 week. And it's just a testament to how volatile markets are getting. So I would love to say I captured all of this, but unfortunately I didn't. I captured a decent chunk of it, but I also left quite a decent bit on the table. But that's fine because, you know, my goal is to capture 1 to 2 days worth of volatility, and that's what I got. Anything else, fair enough, you know, would have been nice to have, but hindsight is 20/20, right? That's the difference. You do things in real time, you're going to leave things on the table. You're going to make mistakes occasionally. You're going to take losses. You know, this is all part of trading. Okay, so now we're going to have a look at some of them which didn't work. And I did actually trade a couple of these myself this week, and Eurosec is one of them. I did go long, and you see we started to bounce. See how we start to reverse? I did go long here, and instead it breaks down. We don't get that bounce. What we see to the downside is what I want to see to the upside. That's what I'm looking for. Instead, we break down. I'm involved with this. We get to the second lower bound. I add a second position, and we get a bounce. Why? 95% chance of pausing or reversing from this level. And as we bounce, you can see the cost average between these two right in the middle. We bounce, and I actually exited that. I exited this one for just a very small loss. I actually decided, for whatever reason at the time, maybe the news event coming up or something, I decided to book it just before the break even. So just clear it off the book for a small loss. That's an example of one I did take this week, which didn't work. But because I risk managed it from the second lower bound, I ended up getting out for basically a scratch, more or less break even, just under in this case. Another example of this was Euro New Zealand, which I went long this week. Also, we had some quite volatile markets this week, also broke through its first lower bound. Cost averaged it at the second lower bound, just as I talk about in the weekly analysis videos, in the weekly Forex forecast videos. It too bounced, and that one I did take off for just over break even. So basically a scratch trade as well. So there's a couple of examples there which I did take this week which didn't work, but I was able to get out of them for more or less break even purely because I added at the second upper or lower bound, in this case both second lower bounds, cost averaged the first position and then exited on the bounce. And this is what I'm talking about when I say in the weekly analysis videos, if we get here, whether I'm involved or not, I'll be looking for an additional position. And so just wrapping up with a quick final example of an intra-week breakout Euro Aussie. A market can be a buy or do nothing. Selling is not an option. And I'm on the 1 hour time frame just because you can see this pattern a little bit clearer. But you can do it on the 4 hour time frame. It shows the same thing, but it just shows it clearer in the 1 hours. We're kind of consolidating, chopping around. We do have a rally higher, and then we start to pull back and we actually fail, comes back, tests the low. And then you get this kind of nice secondary inverse head and shoulder. See how we break up? We kind of get this flag in the 1 hour, and then we rally into the high. So you can look for 1 hour bull flags as well as 4 hour bull flags. But if you are on the 1 hours, very often you can get more than just one in the week. You can get maybe two. But on the 4 hours, you tend to just get kind of one kind of bull flag. But a nice example of an intra-week breakout pattern. We're coming down, we're trending down. There's your first high, there's your momentum. It flags. And for your kind of Fibonacci trades, or those of you who trade that kind of stuff, that's where you get your trade into the upper bound and look at where it stops. So if you're looking at booking profits, where's the target? It's the upper bound. Why? Because 68% chance, 70% chance of pausing or reversing once you hit this area. And wrapping up the video, as always, with gold and silver. Now, we don't do anything different with gold and silver. We're looking at this exactly the same way we've been looking at any of the other setups throughout the video. And you can see silver does also pull back, nicely test its upper bound. Where does it reverse intra-week? 29.03. So these are the kind of setups, the kind of trades that I'm looking at. Very often, this will generate 1 to 2 days worth of volatility. And out of the 5 days, that is what I'm looking at capturing. And that is what I'm doing in real time throughout the week with members, including in the assets that we're actually looking at in the weekly Forex forecast in the weekly analysis videos. So I'm going to wrap up the video here. Hopefully that gives you a better understanding of what we're doing in the weekly analysis videos and why we're doing it, as well as the quantitative data that we're using in order to look for these setups each week. If you're interested in joining us in the live room throughout the week, feel free to check out the link in the description below for more details. So that is it from me for today, guys. As always, I hope you enjoyed today's video, and if you did, why not consider joining us in the GMT training room each day, where I look at the best markets as well as sharing real-time setups that I'm personally looking at trading with members as part of our GMT training program. Don't forget, you can also get a 2-week free trial to the cutting-edge hedge-trading app used in today's video by heading over to www.hedge-.com. Access to the cutting-edge hedge-platform is included with every GMT membership.